Building a diversified investment portfolio is one of the most effective strategies for managing risk and achieving long-term financial success. A well-diversified portfolio spreads investments across various asset classes and industries, helping to reduce volatility while enhancing growth potential. This guide will walk you through the steps to build a diversified portfolio, ensuring that you're positioned for steady, long-term returns. 1. Understanding diversification. Diversification is the process of spreading your investments across different assets to reduce the impact of poor performance in any one area. The idea is simple. By not putting all your eggs in one basket, you minimize the risk of losing all your money if a particular investment doesn't perform well. In a diversified portfolio, if one investment declines, others may still perform well, balancing your overall return. 2. Allocate across asset classes. One of the foundational steps in building a diversified portfolio is choosing the right asset allocation. The three primary asset classes are stocks, equities. These represent ownership in a company and typically offer higher potential returns, but come with higher risk. Bonds, fixed income. Bonds are generally safer investments that provide consistent income but offer lower returns than stocks. Cash or cash equivalents. These include assets like savings accounts or money market funds that are extremely safe but offer minimal returns. A balanced portfolio includes a mix of these assets. Your asset allocation should depend on factors like your age, risk tolerance, and investment goals. For example, younger investors with a long time horizon may prefer a higher allocation to stocks for growth, while those closer to retirement may favor bonds for stability. 3. Diversify within asset classes. Once you've chosen your asset classes, it's essential to diversify within each one. For stocks, this means investing in different industries: technology, healthcare, finance, etc. Regions: US, international, emerging markets, and company sizes: large cap, mid cap, small cap. Diversifying within stocks ensures that your portfolio is not overly dependent on the performance of a single sector or country. For bonds, consider varying your investments by issuer: government versus corporate, credit quality high grade versus junk bonds, and duration short-term versus long-term bonds. A mix of bonds can protect your portfolio from fluctuations in interest rates and economic conditions. 4. Use low-cost funds. One of the easiest ways to diversify is by investing in low-cost mutual funds or exchange-traded funds (ETFs). These funds pool together money from many investors to buy a broad basket of stocks or bonds, providing instant diversification. For example, an S&P 500 index fund gives you exposure to 500 of the largest U.S. companies, while a bond fund might include a mix of government and corporate bonds.